Hi, this is Mike Lingle from Rocket Pro Forma, and today we're going to evaluate financial projections. So this is a 3-year projection from a startup, and the way this is set up, you can see the months here for the first year, and then you see a summary of those 12 months, and then you see year 2, and you see year 3. And this business model has 2 main KPIs. There's a subscription, and there's also some sort of transactions that are being sold. Probably the subscribers also do a transaction, or there's some other audience. Maybe there's 2 different customers. Anyway, there are subscriptions and there are transactions. And so at the top here, we can see the number of paid subscribers we have at any given time. So we add new subscribers, some old subscribers churn out, but over time, the number of subscribers grows. And then the number of transactions per period, you can see we start small, but by the end of year 3, we're doing close to 100,000 transactions a month, which is 900,000 divided by 12, more or less. And then you can see that's driving revenue. And one thing about these financial projection slides is that these numbers are in thousands. So this is 38,000. This year 1 number is 4.9 million. Year 2 is 81 million, and year 3 is 324 million. So that's a lot of growth. And I actually created a breakout here. So the subscriptions is driving a little bit of that. So if we're doing 81 million in year 2, subscriptions is 1.8, close to 2 million of that. New customer transactions is 20 million. So the transactions are a huge driver of the business. But then repeat customers, people who come back to do more transactions, is $60 million of that business. So 3/4 of our revenue is coming from repeat customers in the transactions. And that is potentially an issue. I'm not sure if the creator of this financial model actually intended that, because that's just a giant driver. So I would watch that. Also, take a look at that and just make sure that's what was intended. Also, when you see this kind of revenue growth, if you're making $324 million a year, it's unlikely that you can do that with 24 employees. So down here we have headcount, and we see we're starting with 4 employees. We get to 13 by the end of year 1, 19 employees by the end of year 2, 24 employees by the end of year 3. But meanwhile, the revenue isn't going from 5 million to 81 million to 324 million, which means our revenue per employee in year 1 with that $5 million revenue is $383,000 per employee. In year 2, it becomes $4.2 million per employee. And in year 3, it becomes $13.5 million per employee of revenue. And that's really high. I think Microsoft and Apple each do like $1 million of revenue per employee, maybe a little bit more. But most companies are in the $200,000 to $500,000 of revenue per employee range. So just watch that. And then cash at the end of period, again, these are in thousands. So this is saying, the company will have generated an extra leftover $447 million by the end of year 3. So that seems high. So just, I would double check these things. It's possible to build a company that does this. You just want to make sure that that's actually what's intended. So check it out. Thanks. This has been Mike Lingle from Rocket Pro Forma. If you have questions, or if you want me to evaluate your financial projections, just reach out to me. Thanks.